Hi, I would like to welcome you to my presentation today to discuss and understand key transmission mechanisms of monetary policy. Before beginning, I would also like to take the chance to present you my student ID with my name and Swiss matriculation number. Let's begin. In the presentation, we are assuming that the central bank of a country decides to increase the short-term interest rate, also called overnight interest rate or policy rate in the phrasing of the Swiss National Bank. The initial transmission will take place on the short-term debt market, also called money market, and today we are going to look at how this transmits, how it spreads to longer-term financial markets, first bond markets, then to wider borrowing rates, stock prices, and finally the foreign exchange rate. The money market is at the heart of every other transmission channel, and I also put a heart in the background. I developed my own interpretation of the theory based on chapter 15 and 16 of the course textbook, which I would like to present. There are two key mechanisms. One can be seen on the left side. The primary monetary policy tool of the Fed would typically be an open market operation, more precisely open market sale of securities to a primary dealer. These are bonds, bills, notes, and so-called TIPS issued by the US Treasury. By doing so, the central bank will decrease its non-borrowed reserves, shorten its balance sheet, and flood the market with these securities, which will send the price of the securities down and their interest rates up. The other mechanism, seen on the right side, would be to target the interbank lending rate on the overnight market, also called the federal funds rate. Fed acts by setting something similar to a cap and floor, whereby the cap would be the so-called discount rate, at which banks can borrow funds from the Fed to fulfill their required reserve requirements. However, this rate is set usually a fixed amount above the federal funds rate, and hence banks are more inclined to borrow from each other at a lower rate set by them. The floor is the interest rate paid on all reserves funds by the Fed. It is set a fixed amount below the federal funds rate. Here banks again are more inclined to lending at a higher rate between them in exchange for a higher return. So, the market for reserves is where the federal funds rate is determined, and this can be analyzed with a simple supply and demand analysis. In case of an interest rate hike, banks are generally required to pay more interest on their liabilities, who would pass on any costs to the left side of their balance sheet and claim higher interest rates on their loans. Ultimately, the Fed's use of these policy tools has a very important impact on interest rates and economic activity. An interest rate increase will generally discourage borrowing and, so to speak, as the price of the money increases, economic activity decreases and aggregate demand in the economy lowers as well. The ultimate goal of the central bank would be to maintain price stability in the economy and in financial markets, also on the foreign exchange market, which is going to be my last point today, and secure interest rate stability throughout the economy. Okay, now we have seen how interest rates for US Treasury securities are influenced by the Fed. How does this transmit to bonds with longer maturities and especially corporate bonds? It seems plausible that the overall interest rate paid by a security over its lifetime and until its maturity would equal the sum of the average expected one-period interest rates or yearly interest rates. This is what the so-called expectations theory postulates. This explains why interest rates on bonds with different maturities move together over time and why yield curves tend to slope up when short-term rates are low and slope down when short-term rates are high. Why do, however, yield curves usually always slope upwards? So let's include interest rate risk and assume that investors generally prefer bonds with shorter maturities that have less interest rate risk. This corresponds now both to theory and empirical data. Let's look at the yield curve now. So the liquidity premium theory takes the theoretical concept of the expectations theory and adds the very plausible liquidity premium to those rates. Bonds with different maturities are only partial substitutes. The liquidity premium is positive and increases with the term to maturity. I would like to take another graph to visualize the equilibrium bond price in the market. Here, I just would like to stress again that the bond price is always inversely related to its yield. And on my last graph, see on the bottom, here, I would like to show supporting, also to you, probably very familiar evidence for the correlation between short-term and long-term interest rates in Switzerland. Before continuing the discussion at this point and also relating to the money market, I would like to stress and leave out further discussion about whether the policy rate rise is taking place within the framework of expansionary or contractionary monetary policy, because it can in some cases also cause a fall in short-term rates. However, a rise is the common reaction from financial markets. Broader borrowing rates. The transmission to wider borrowing rates again are explained by the liquidity premium or risk premium expected by lenders for riskier assets on the market for marketable debt. See a graph from Australia. Generally, securities with longer maturities or securities with high risk, such as corporate bonds over government bonds, would claim higher interest rates. Also, mortgage rates on the real estate market are considered risky assets. This all suggests that a higher real short-term interest rate, as long as it is expected to persist, leads to an increase in the real long-term interest rate. Now, we know from Keynes that these increased real interest rates then lead to a decrease in business fixed investment and more in terms of present times, a decrease in residential housing investment and consumer durable expenditure, all of which produce the decrease in aggregate demand. Common stock prices. Stocks are considered riskier assets than bonds and hence pay higher returns. Let's look at them with the help of the Gordon growth model, which is a dividend valuation model. In this equation, expected dividend payments continue into infinity. If raising interest rates contribute to higher bond yields, not the required return, here K would also go up. K usually takes bond rates and adds the risk premium. So we have now higher required returns, but as an interest rate hike has a contractionary rather than expansionary effect on the economy, the expected dividend growth rate, here G, would fall. Our denominator in the equation is now higher, and the price of the security on the left side of the equation will be lower. Common stock prices and the price of similar dividend or cash flow paying assets decrease. The ultimate effect is a fall in overall stock market wealth, and this contributes to a further fall in consumption and again the aggregate demand Y. Coming to my last point today, the foreign exchange market. A higher interest rate offers lenders a higher return relative to other countries. This causes the demand curve to shift rightwards, signaling a higher demand for the domestic currency. Not for the foreign currency, but for the domestic currency. So what happens typically is that the higher interest rates attract foreign capital and the new exchange rate will be now higher. Overall effect on the economy is that now net exports fall, since domestic products will be now more expensive to foreign businesses and consumers, therefore aggregate demand Y falls. Now we have seen what happens if a drop reaches the water surface and a wave starts in all directions. These were the money markets and all of its effects spreading out to the real economy. At the end of the presentation, I would like to give you a further outlook on the wider economic consequences. It's important to understand that the conventional monetary policy of central banks nowadays doesn't determine the money supply directly anymore, but rather the medium-term inflation forecast. By setting the federal funds rate, ultimately the economy will determine the quantity of money needed and used in the economy. Money demand is a back and forth between businesses, consumers, and the central bank, where retail banks act as intermediaries. Understanding the wider economic consequences of an interest rate hike would be, from a consumer perspective, is that investments now pay a higher return and are therefore more attractive, so consumption will be postponed to later periods. From a business perspective, however, high interest rates increase the cost of borrowing to invest in productive capital. Both together, the lower demand for consumption and lower investment in productive capital leads in turn to lower demand on the labor market. This also translates to now lower home ownership rates, as it comes forward from your paper from 2018. Eventually, the balancing effect of the domestic price level and import price level will have the ultimate effect on price level stability and the stability of financial markets in the economy. Having said all that, I thank you for your attention, and I hope you also enjoyed my presentation too. I'm looking forward to receiving your evaluation at the end of the semester. Meanwhile, I wish you both good health, and I'm already looking forward to our next class together on Monday the 20th.